Hello and welcome back to The Note. Is AIM's aim true? There's a lot of interest and a lot of controversy surrounding London's alternative investments market and how its companies perform compared to other smaller companies. Well, today sees the publication of the annual great set of data on this produced for Numis by two academics from the London Business School. It gives us sheds a lot of light on the question. With me now to discuss it is Paul Marsh of the London Business School. Paul, thank you very much for joining me once more.
Thank you, John.
Now, let's start by taking a look at the story for 2013, which suggests that AIM shares have again had a bad year, but perhaps there is some good context for that. What's the story for 2013 as you see it?
Okay, the story for 2013 is that actually AIM's had a better year than in recent years.
Right.
If we look at the left-hand bar here, you can see that the return was about 21%, which for a year's return is very creditable.
Yes.
The disappointing thing about it is when you compare it with other smaller companies. So if you look at the Numis index, which is the bottom 10% of the market,
Which is the one that you
we produce,
yeah.
And that's on an ex-investment companies basis, that's performed much more strongly. And we also produce a Minnows index of the bottom 2% of the market, which has performed even better than that.
Right.
So the question is why, although AIM's had a good year, has it had a much less good year than other smaller companies? Well, that's because it has a very big weighting in resources, and the resources part of the AIM index has performed very poorly, minus 16%.
But I mean, that's a global phenomenon, obviously.
That's a global
prices
phenomenon.
have been bad.
Nothing to do with AIM.
Right.
All resource stocks have had a bad year. So if we exclude those resource stocks, you see that AIM is actually coming up quite well. And if you also exclude the investment companies, which gives you a purer measure of the smaller companies within AIM, it's on a par with other smaller companies last year. So AIM's had a much better year than in recent years.
Okay, now let's put that in longer term perspective. This is a really quite startling chart. So the NSCI is your index of the bottom 10% of market cap of the UK.
Indeed.
And then the FTSE Aim all share is what its name implies. And this is quite startling long-term underperformance. Well, how can we explain why companies that happen to be listed on AIM do this poorly compared to other small companies?
Right, well, let's just show how poor this
Yes.
is. This is if you had started at the beginning of the FTSE Aim All Share Index, and the bottom blue line here shows that you would still be underwater in terms of your initial investment, even with dividends reinvested. Even with dividends reinvested. And this is a period of getting on for 18 years. In contrast, the Numis Smaller Companies Index, that's smaller companies that are listed on the full main market of the London Stock Exchange, have turned in a return of nearly 10% per annum over that period. So this is really a startling underperformance.
Now, is this in part, one of the reasons people give for this is that once AIM companies do really well, they get promoted and they no longer appear in the index when perhaps they should? I gather you've done research on that this year.
Yes, I mean, we've also looked at that. I mean, as a business school, we cherish our graduates and our alumni,
right.
and so does the AIM market. And so we thought we should also look at what happens if you were to construct an AIM index that not only contains current AIM stocks, but anything that's ever been quoted on AIM.
Right.
So it's AIM plus alumni. And when you do that, unfortunately, instead of ending up at an initial index of 100 becoming 89, it becomes even lower. And so the performance, including the stocks that have been promoted out of AIM, looks even worse than
So some of them have been successful, but enough of them have crashed and burned that overall they actually were worse.
Absolutely. There's been some very big winners. There have been some, if you look at the market today, there are some large FTSE 100, FTSE 250 companies that were previously on AIM, but there have been too many of them that have lost their value or lost a substantial amount of their value.
So in your professional opinion, what can explain this extraordinary divergence? Why does a company happening to be on AIM mean that it is likely to perform this poorly?
It may not be anything to do with AIM per se,
Sure.
but it may be to do with the kinds of companies that are listed on AIM. As we've seen, there are industry and sector differences, but I think that probably some of the biggest differences are to do with the fact that this has been an IPO market. This has been a market where Substantially, AIM has been fueled by new issues and companies going public over time. And we know that that also tends to lead to underperformance, that IPOs historically have not performed well. And AIM is full of them. The majority of AIM is unseasoned companies. So this is not an unusual pattern for unseasoned companies. There may also be elements to do with the regulation of AIM. AIM is more lightly regulated, and that may also have led to some of the underperformance. It may also be to do with other factors, but it is a bit of a puzzle, because you would have expected at some stage along this route here that investors would have recognized this pattern and would have sharply marked AIM stocks down until they gave you a prospective return in the future, which was comparable with other smaller companies. And that does not seem to have been the case. It seems to have been a constant disappointment. Hopefully, though, 2013 might be the beginning of a new era.
Okay, Paul, thank you very much indeed. Let's all hope that. One important point I think we should make out, 2013 was a good year for AIM. In the longer term, and this excellent research shows that very clearly, it's been a success for issuers. It still has very big questions to answer about how much it has delivered for investors.